My guest stars here, Nick, thanks for joining us.
Thanks for having me.
And Joe Massey at Castle and Cook Mortgage.
Yeah, thanks for letting me join. Never want to miss these, and appreciate you always having me on, Lon. Thanks so much, guys.
Great. So if you guys in the audience take a look on the right-hand side, you should have a chat box. So if you've got any questions, feel free to just jot those down there, and we will try to answer all your questions as we navigate through all this. I'm going to push this over to spotlight mode if I can remember how to do that. If not, it's not that critical probably. Make the screen a little bigger for you. Does that look all right?
That looks perfect.
Great. So we're going to go through the national trends. I'm going to show you some actual case studies. The reason for us doing this is that a lot of people make investment decisions based on what they hear at the coffee shop or what their golf buddy whispers to them, and they don't necessarily have like a comprehensive view of everything that's going on. So I hope I'll be able to give you more data, give it to you in a way that you can actually interpret it, and then really make some great decisions from that. So none of this is obviously an income claim. I'm just going to try to show you what I'm seeing in the papers and how we interpret them. Just a quick note from the attorneys. There's a lot of forward-looking statements I'm going to talk about. Will, may, should, expect, continue, anticipate, believe. These are based on what I've found in the media, research that we've done, our analytics, and it's all company source information. So you're going to want to do your own research about the status of the market, draw your own conclusions about the best time to buy and sell, and then review that with your attorney, financial advisor, CPA to come up with a comprehensive look at how all this information fits into your overall portfolio to make a great decision. Don't just rely on us. Okay. So here's the main client summary points that if you are a realtor working with a client that you might be using right now. So the first is, we had a couple of unicorn years in 2020 and 21 when the mortgage rates were driven to unprecedented low levels. And then, Joe, when did the interest rates start going up? Was it somewhere around early 22?
It was April of 22.
So, we had kind of a snapback where the prices slowed down a lot. Volume slowed down when the mortgage rates went up so high. So it's becoming a little bit more of a normalized market than that crazy time that we did have. Rates have improved from 8. Joe, where are we at now that we saw the 10-year Treasury drop a little bit in last week?
Yeah, just under 7%. It's like 6.99 as of today, Lon.
Yeah, so it's a big improvement from the spike that we got to. So what do we think is going to happen on a macro standpoint? I think that prices are going to be mostly flat in the Denver metro area and probably for most of the country. The reason for that is that inventories are increasing because more sellers are deciding, even though I've got a really cheap rate, my family situation's changed, I need to sell. But the number of buyers has been relatively stagnant this year, largely because of high rates. That's easing up a little bit now, so that might get a little bit better for us. But I think the main point here is that we're probably not going to see a lot of sales traffic for the balance of this year. And since there's not going to be a lot of sales traffic, we're not going to see prices go up very much. New construction is doing really well. A lot of times, Joe, are you seeing the builders are offering a lot of buy downs to get people in?
They are. Yeah, they're offering really insane deals. I mean, I saw one just yesterday. It was a 30-year fixed at 4.5%, and the buyer was like, "Hey, Joe, can you match that?" I was like, "No, I'm sorry. I actually can't pay you $35,000 to do your loan." So builders are doing a lot. They're giving up a lot on what they would make on the mortgage in order to maintain their high prices and high transaction volume.
So just think about that. The lender is getting a $35,000 subsidy from the builder to get the rate from 7 to 4.5. That's just absolutely insane. And then looking forward, we'll certainly talk about this in a lot of depth, but Joe and I don't expect mortgage rates to drop a lot more in 24, and we'll explore that in some detail. So what does this mean for you if you're a first-time buyer? I would try to encourage you to buy right now before the rates drop. The reason is that when the rates drop significantly, we'll see a lot of buyers flood into the market, and it'll get a lot more competitive where there's multiple offers. You might have to give up your inspection or your appraisal. And right now, since there's more sellers, it's a little bit more in the buyer's court from a negotiation standpoint, and you want to take advantage of that and then just refinance when you can. Joe, how hard would it be for someone to refinance if the rates drop in the future?
It'll be very easy, and one important point is we offer two things to help buyers right now. Number one, every client that's purchasing with us right now, we give them a free 1-year buy down. So back to what you mentioned earlier, interest rates are 6.99%. When they work with us, their interest rate will be 5.99% for that first year. And then we also give them a free refinance voucher. So at any point over the next 30 years, when interest rates decline, they can give us a phone call, refinance that loan to a lower interest rate with no closing costs. So it's a very easy process to refinance.
That's absolutely fantastic. And what's the rule of thumb? Is it a point and a half of rate drop to make it worthwhile to go through the exercise?
Yeah, it's generally about 1% to make it worthwhile. But as prices go up, it's actually not as much that you need to lower the interest rate. So right now, it's actually only 0.75%. If your rate goes from 6.99 and in a year interest rates are at 6.25 or 6.24, it would make sense to refinance to save money, particularly because it's free.
Yeah, that makes a ton of sense. So if you're a trade-up buyer and you've got at least an average quality house, or even better if it's a nice house, I'd buy now for all the same reasons we just discussed. Make sure your house looks really great. The reason for this is a lot of buyers are really stretched on their down payment. They are just barely qualifying. They don't have a lot of cash left over for a remodel or buying new appliances or getting new carpet or whatever is required. So if you've got defects in the house that are going to be hard for someone who doesn't have a lot of extra cash, they're just not going to buy your house. So you'll need to do that work to really have the largest possible buyer pool and generate some competition. If you're an owner-occupant seller and you don't need to buy, I would tell you to wait. This is a little bit soft for the market right now, and I do think that it'll firm up more in the favor of the sellers probably early next year, probably next spring, actually. And you'll probably get a better price, and you might even be in a situation where there's multiple offers and you can really negotiate hard. If you are a trade-up buyer and your house is below average and you're not in a position to do the renovations to make it look nice, it's not going to sell very quickly. When it does get an offer, it's probably not going to be an offer that you're going to like. You're not going to be in a strong negotiation position. All this adds up to just wait until probably spring of next year if that's feasible for you. And I think you're going to have a much better outcome than trying to sell today. If you're an investor buyer and you can find something that makes sense, which is a little bit difficult right now, buy it. The detached single families and the duplexes, I think, are probably the most attractive thing to buy right now because there's still a scarcity of that type of rental product in the Denver market and most markets across the U.S. There's a surplus of apartments in many markets across the U.S. So rent growth on the single families is going to do better than the rent growth on the apartments for probably the next 24 to 36 months. So that's it. So if you guys think of questions as we go through here, drop them into the box, and I'd be very happy to have the team try to address those. So there's a problem in that Americans, on average, think that the economy is a lot worse than it is. I'm not going to read the slide to you. We'll make the whole deck available to you guys. You can read through it later. And we're seeing that the consumer's assessment of is this a good time to buy a house is at like a 15-year low right now, which is why we're not seeing a lot of buyer activity. Interestingly, though, when you ask the same consumers, do you think that home prices are going to go up over the next 5 years? On average, they think it's going to go up 4% per year, which is about the best number we've seen over the last 15 years. So I think it's near-term frustration with rates, not concerns that prices are going to go down or that homes are a bad investment that's holding people back. So for the realtors that are on this call, I think that might be your main education point is collaborate with your mortgage broker, find out the options to make it easier for your buyer to get over that purchase price and financing issue, because it doesn't seem like it's an appreciation issue.
I agree.
So the great news is that in the media, there was a lot of discussion about a year and a half ago, late 22, that we're going to have a repeat of the 2008 crash. And the monthly surveys during that period of time found that close to 40% of Americans thought home prices are going to go down. And as that has gotten out of the media, it's dropped down by almost half. So the barrier of people not wanting to buy because home price drops is going away. So we talked a minute ago about the number of people who want to buy a house is really low right now. And why is that? It's mostly just because of the rates like we talked about. So Nick, do you want to talk about this one? Like, why should you still buy real estate?
Yeah, I mean, I think this graph does a fantastic job at illustrating the overall net worth impact of a renter versus a homeowner. And if you look at just the last, this graph shows 2010 to 2022. So the 12 years in between, there was a remarkable increase in net worth to the average homeowner relative to the renter. And you can clearly see going back to 2010, the average homeowner had a net worth of about $187,000. That number 2 years ago ballooned to $396,000. Well, in that same period, a renter would have only seen their average net worth go up about $5,000. So just a huge difference. And I think this really just continues with what you were saying, Lon. Why now is a good time to buy. If you're in a market like Denver, you're likely going to continue to see appreciation, probably not at the extremely high levels that we saw over the last couple of years, but even at the maybe a 2, 3, 4% per year range, you're going to see your net worth increase dramatically relative to the renter, especially as rent growth continues to go up. So I just think this story tells the narrative here is that own your own home and buy real estate because renting is only going to continue to kind of put you, I think, further in a hole.
Absolutely, no doubt. So interestingly, this survey came out about a month ago where the Gallup poll guys asked Americans, what's the best long-term investment? And the majority of people, not the majority, the largest, most dominant category was real estate, quite a bit higher than stocks and bonds. So I am glad to see that long-term, I think we're in a good position with our consumers. It's just a near-term problem getting people to want to buy.
Hey,
so if you drill down, yeah, please.
I like that cryptocurrency is now invaded into this space, and it's 3% of people think that cryptocurrency is the best way to build wealth.
Yeah, I know a couple of people who've done really well, but not very many. So if you drill down and ask homeowners and renters, like, why do you think buying a house is such a good idea? There's a whole array of reasons. The emotional fulfillment that you have, the fact that it's emotional and permanent, and then you get to have decision rights over your space, not have the landlord make decisions for you. A lot of great benefits. So for those of you first-time buyers that are struggling, I hope this couple slides will help you to make the case that it's still really worth considering. So we saw the vast majority of people are not worried about a price drop, but that doesn't mean that everybody feels that way. You may run into a client that is worried about maybe prices are going to drop, so I want to wait. So if that does happen, I've got just a couple slides for you. So the first is, here's the year-over-year price change. You can see, like we referred earlier, in 2021 and the first part of 22, we saw massive price increases because the mortgage rates were so cheap. That's ground to a halt. We expect the home prices to be relatively flat going forward over the next year or so. So this chart, I think, is the one to show to the person who's worried about prices dropping. This shows you the average appreciation since 1991. And you can see, for those of you guys who are in Colorado, we're one of the best 3 states, Utah, Montana, and Colorado, with over 570% appreciation. The overall average for the whole U.S. is about 300%. So, even if in a nightmare scenario, if we had a 2 or 3% price drop next year, over the long haul, nothing even comes close to real estate for appreciation.
Hey, Lon, can I have you go back one slide, one more? So I want to point out something. If you look on the very far right, there's a tiny little blip where prices did decline in the fourth quarter of 2023. So we hear a lot of people that say, hey, I'm waiting for prices to go down. Prices are going to go down, and that's when I'm going to buy a property. I would show this to your buyers. They already did go down. They went down for about 2, maybe 3 months, and now they're on the way back up. So if you've got clients that are using that line or saying, hey, I'm really waiting for prices to go down, show them this slide. They already did go down, and now they're on the way back up.
That's your opportunity there. Sorry.
Yeah. Hey guys, we have a question from Robert. Impact of huge insurance increases is causing some homeowners, such as in Florida, to stop paying for home insurance. Not really an option for homeowners who have a mortgage. Many owners looking to sell, ? Are prices dropping in Florida? what is the impact in Colorado of higher insurance costs on home values?
Well, Joe, you could probably speak to this, but I think that the average consumer buys on the monthly payment, not on the price. And that share of wallet includes tax and insurance and HOA. So if the HOA and tax or the insurance goes up, there's just that much less that's available for the rest of the payment. But what's the buyer psychology that you tend to see on that?
Exactly what you just described, Lon. That, hey, we're buying on the total monthly payment, and yes, insurance has gone from $100 a month to $250 a month. So instead of buying a $500,000 home, maybe I'm going to buy a $440,000 home. And that's just part of the conversation that we have with folks. What is your budget? What can you afford? And how much money do you have coming in? What you can afford on a monthly basis translates to Z purchase price. And sometimes that purchase price is not as high as you might have hoped, but people will still buy. So it does put a little bit of pressure on the lower end buyers because they have less flex in their budget. But I don't think it's going to make a huge impact on home prices because we're still so short of inventory, which I'm pretty sure we have a slide on due to lack of construction over the last 14 years.
Yeah, I think that's definitely true. And then I think part two of Robert's question is this negatively impacting the prices in Florida? So if you take a look at the fourth quarter of 23 versus the prior fourth quarter, home prices in Florida were up 6.9%, which was just about at the national average. So it hasn't slowed it down yet. This doesn't disaggregate homes from condos. I wouldn't be surprised if you found in Florida that the homes are a little worse. And the condos are a little worse. The homes are a little better, but I don't have that data for us. So I apologize for that. And then about inventory growth. Yes, in Florida we've seen May of this year versus May of last year. Florida had a 70% change. Actually, Florida leads. They had more increase in inventory than anybody else. And Robert, your question is probably a big part of the driver of that.
Yeah,
the average increase was 35. It's a really interesting chart, actually. Nevada had a decline in inventory. I wonder what drove that.
Yeah, that is interesting.
If anybody knows, let me know. So we're going to see that appreciation is probably going to follow where we're seeing changes in population. So this chart, the dark green areas are the areas having the most growth in population. And no surprise, Texas and Florida lead that. And there are also states that are having high appreciation. If you take a look at, say, California and New York and say around Chicago, not nearly as much. And those are places where prices are sort of flat or declining just a small amount. So if you ask all the experts what's going to happen to home prices, the average across all of them is that prices will go up 3% this year. That's probably pretty good.
I feel pretty confident about that number.
Yeah, I do too. So if you ask those same guys back in December of last year and March of this year, they were thinking 2%, 4%. Now they're at 3%. So they're sort of swirling around that sort of a range. So Joe, can you talk a little bit about debt to income and why lenders like to look at that and kind of where we're at overall for the economy right now?
Yeah. So debt to income for an individual is the amount of money that you have coming in. That's the income piece, and how much money is going out to pay your debts. This chart shows that 25% is kind of the ideal. Sometimes we see folks more than that. Sometimes we see folks less than that. But it has really increased since January of 2021, where you see we were at a pretty low level at 13.3%, meaning the average American was spending 13.3% of their pre-tax income on their debts. So credit cards, auto loans, mortgages, et cetera. And that has increased really, really rapidly. And now we see that the average American spends 27% of their income on servicing their debts. And that's a function of two things. Well, three things maybe. Number one, increased home prices that are leading people to have to get bigger mortgages. Number two, increased interest rates, which are leading people to have higher payments on those increased mortgages. And number three, increased credit card debt. That's not necessarily something we always talk about in this presentation, but it does factor into this graph. And people are spending a lot of money for their overall debts.
Makes a ton of sense. So when we talk about there's probably not going to be a lot of room for prices to go up over the next couple of years, this is the main thing I'm thinking about, is that the consumers just don't have enough extra cash to pay a whole lot more unless the rates were to decline a lot. And I just don't see that happening.
I agree.
Speaking of which, so this is a great chart. The purple, if you look in the upper left, the purple line is the home price and the red line is the average wage. And you can see that the home prices have accelerated a lot faster than wage growth, which has made it a little bit tougher for people to qualify. The lower right just shows the affordability index. So in 2011 and 2012, if you remember, we had pretty low interest rates on like a 50-year basis. And the average home price in America dropped about 20-25% after the great financial crisis. So the homes were really cheap. There were plenty of them to choose from. The buyers who did want to buy had a lot of free debt or close to free debt. So it was extremely affordable. That was a one-time blip, So right now we're on the other end of the pendulum, and the pendulum will swing back. Nothing ever stays like this for long.
That's right.
So lack of inventory is what's holding us back. So we're seeing a good increase in inventory in the last couple of months. So if you look at 24 versus 23, it's a very dramatic increase in inventory, and it might be easy to kind of be frightened about that. But what I'd like you to look at is the left-hand chart, left-hand side between 17, 18, 19, and 20 pre-COVID. Typically in May, I'd expect to see 1.1 million homes for sale across the whole U.S. We're a little short of 800,000. So we're still about 25% below where we should be. So don't be too alarmed about this increase in the inventory. It's not the world's going to come to an end or anything like that. Let's see. So I would expect that with the inventory build that the prices will increase a little less fast. We talked about that quite a bit. So I'm going to skip these. We talked about that last time. Joe, in brief, is there going to be a foreclosure boom?
There will not be a foreclosure boom, no. And just real quickly on this chart, getting a loan right now is as conservative as it has been over the last 20 years. There's still plenty of options, right? We work with self-employed people, W-2 wage earners, retired folks. But when it is a little more arduous to get a loan, that means that everyone or that the folks that do buy qualify and qualify really, really well. And when you have a highly qualified borrower, if there's a blip in their personal life changes, their personal life circumstances, they're not just going to let that home go to foreclosure. They're going to use their reserves. They're going to get a second job. They're going to find a way to make the payment. So people are really, really well qualified when they're buying homes today, and well qualified people make the payment.
The next couple slides have got more data on that if you need it, but that's not coming up as a question nearly as much as it was about a year ago.
No.
But this slide is always going to be fun. Everyone always wants to know what's going to happen to rates. So this is the chart I saw about a week ago from McKinsey, just showing the number of expected cuts in the mortgage rate. In the Fed short-term rate. And back in December of last year, everybody was pretty much in the consensus it'd be 3 cuts or more. More than 3 cuts. And currently we're thinking there's no chance of 3 cuts. Most people are thinking it's going to be, 1 or 2. But it's really interesting to see how the sentiment and the dialogue in the media has changed over the course of the year. So maybe the main thing to take away from this is that the experts are always predicting stuff on the media, and they're usually wrong.
Mm-hmm.
I don't even know
this
if
is a
there's
great chart. I'm glad you found this. I like this.
This one really shows it pretty well. So for those of you who work with commercial, this slide and the next slide show the last 90 days, the typical rates for different asset classes like retail, office, and multifamily by different vendor type, bank, insurance company, credit union. CMBS is a collateralized mortgage bond. So that data will be in the package for you if you need that. So Joe, you're saying the rates now are 6.99. So that's a good improvement from where we were not too long ago. So with this 6.9 rate, how does that compare historically, Joe?
Yeah. So historically, we're about 1 1/8 less than that 50-year average, or I guess about just under 1% less than that 50-year average of 7.76. And so we have a lot of conversations with folks. They're like, oh my gosh, interest rates are so high. And we say, yeah, that's true. But look at historically, it's not that bad. But the problem with that is if you've got somebody who's in their peak home buying years who might be, from the age 28 to maybe 38, they don't remember the 1980s when rates were 12%, or maybe they were born in the 1980s, but they certainly don't have any financial memory. They weren't watching, CNN and financial reports. They were watching the Saturday morning cartoons, right? So the folks that are in their peak home buying years remember rates at this 6% level, this 4% level. And so 6.9 feels really high. And so I think it's important that those of us that work with buyers, whether they're first time or trade up buyers, we understand that reality, that we look at this and say, hey, we're still, 1% below the historical average, but not for their memory. Their memory is 6%, 5%, even 4%. And we have to help adjust their expectations and understand that's probably a little shocking and a little disappointing to what their friends who got a rate of 2% or 3% 2 or 3 years ago. So it's a tough conversation to have. So while rates are historically less than the historical average, they're up a lot in people's recent memories.
Yep, that's holding us back a little bit. The good news
Mhm.
is that this transition period will probably take, I'm guessing, 2, 3 more years. And if you
Yeah.
take a look at the 70s, 80s, 90s, there's a 30-year period where the interest rates were always higher than they are right now. And we sold tens of millions of houses in that 30-year span. So we still have lots of really good selling years in front of us.
So 2 things I learned, Lon, on my first day in the mortgage business, back on that one
Yep.
slide. 2 things that will always be true. Number 1, people always want a place to live. And number 2, our rates are always cheaper than credit cards. So people will
Yeah.
buy because they get married, they get divorced, they have kids, there's deaths, there's always going to be transactions. And as long as mortgage rates are lower than credit cards, people will use mortgages to buy those homes.
Yep, that's absolutely right. So if you guys think of questions as we go, feel free to drop them in the chat box here. We're actually a little bit ahead of plan due to lack of questions. So Joe, are you seeing that more people are using all cash and fewer people are getting mortgages?
I am. Yeah. In fact, I had a client that I met with just last week. They're buying $1.5 million home, and they're selling their existing property and going to net about 500,000. And then they were going to take about $500,000 out of their stock account, and they were going to get about a $500,000 mortgage from me. And we sat down, went through everything. They said, "Yep, this looks great." And they called me back about 3 days later, and they said, "You know what, Joe? We really like you, and you gave us a great loan option. But we think we're going to be better off just selling another $500,000 in stock, paying the capital gains, and paying cash for that property." And I said, "Hey, I totally understand that. It makes a ton of sense for me. Call me on your next transaction." But I absolutely am seeing more people just simply deciding to pay cash because they don't like a 7% or 6.5 or 7.5% interest rate.
So I think the message for you guys is that while there's certainly a lot of buyers that are constrained due to the mortgage rates impacting their buying power, about a third of the buyers right now are all cash, and this is not a problem for them at all. So there's still buyers out there. And the all
That's right.
cash deals or heavy down payment deals tend to be more on the high end, would you say, Joe, than on the low end?
Absolutely. Yeah. Generally, somebody buying a $400,000 home, that's a first time buyer. They don't have $400,000 cash. They maybe have 20 or $40,000 cash. But somebody that's qualified to buy $1.5 million home, oftentimes they do have $1.5 million. And for them, it's truly a financial decision of, do I want to put down 60% or do I want to put down 100%?
Yep. So Robert asked a great question about the interest rates might be below average, but the affordability might be worse than average due to the high prices. I think you're on the right track, Robert. I think the problem is there's this spread between the average home price has gone up so much so fast, and the wages have not gone up nearly as quick. There is a spread between wages and home prices that's really holding people back. And that's probably why we won't see as much appreciation going forward. So you're definitely on the right track with all that. So Joe, what will happen to rates? In June of last year, so a year ago, we thought that we were going to be at 5.5% according to the economist experts. And then if we asked at the beginning of this year, they thought we'd be at 6.5%, and we're not there. Where will we be this time next year?
One guarantee I always make about interest rates, Lon, is they will be different. And the predictions of, if you look at, first quarter, second quarter of 2025, in the bottom right-hand corner, they've predicted that we'll be at rates of 6.4%. But if you look on the left-hand side, every prediction looking that far ahead has been wrong and has been understated by about 0.5%. So using that calculus, if we assume that the experts have been understating by about 0.5% in June of next year, we're probably still going to be right around 6.9%. But I have been wrong before.
Yeah, I think if you plan for 6.9, you've got more odds of being happy than sad with the actual outcome.
I agree.
All right. Do these increasing rates impact the market? Why, yes, they do. The number of deals that we're closing has gone down because the rates are up. So no huge insight there. The number of pendings is also down. So that's why we feel like the third quarter this year is probably going to be a little bit soft. The number of deals that are falling out of contract is at a high level right now. Not like dramatically higher than our prior peaks, but definitely higher. And I think that's, and Joe, you might have some insight on this. Things pop up on inspection, and we've got cash-strapped buyers who just don't have any extra resources to be able to fix the surprise that came up. And I think that's probably the bigger driver of why things are falling out. But what are you seeing?
Yeah, I see exactly that, but also just a little bit of cold feet. Buyers are kind of frustrated, right? So we had several years that there was really low inventory. That really frustrated buyers. Now we've got a little bit more inventory and they feel better about that, but they've got high taxes, high insurance. Their wages haven't gone up as fast as home prices. Then they've got high interest rates and they're just saying, man, I'm only going to buy a perfect home. They're getting a little picky because they're getting hit from so many different angles. They're saying, hey, if this needs a new roof, you need to fix that, Mr. and Mrs. Seller. I'm not going to buy a house that needs a new roof. And if the sellers sometimes don't want to negotiate, and they say, well, we're just going to put it back on the market. Somebody else will buy it without a new roof. And that's why you're seeing more homes fall out of contract. In fact, right now, we're at a level higher than what we saw as we entered the COVID pandemic, right? If you look back in March of 2020, there were 17% of homes 17% of contracts that went away almost overnight because nobody knew what was going to happen. If you take out that blip right there in March of 2020, we are much higher than we have been in the historical average. So it's a little scary out there for buyers that they want a really pristine home. They're already conceding a lot on monthly payment. They're conceding on interest rate. They don't want to concede on the quality of the property.
So something that might be useful for you is if you're going to be talking to a seller during a listing presentation is to share this slide and get some advanced coaching on when we do get under contract and we get that inspection notice, we might have to be just a little bit more flexible than normally we would be. We just can't take a hard line like we could in 21 or the first part of 22 when the sellers were really in charge. We don't have that kind of power in the negotiation right now. And this will help you out with that, to make that point. So the MBA is the Mortgage Banker Association, and they track a large spectrum of the lenders who work in America. And the left-hand side shows the number of prospective buyers applying for a mortgage. And the heavy blue line at the bottom of that left chart shows you this year's performance relative to about the last 9 years. And you can see the number of buyers who are applying for a loan is quite a lot less than historically we've encountered. Since Memorial Day, we are just at that gold line, just above it. So it's improved a little bit, but not by a lot. So I think of that. Joe, how long is the usual delay between when they apply with you and they go under contract? Is that like 60 to 90 days?
It's about 30 days on average. So if we pre-approve somebody today, sometimes they go out and get under contract tomorrow. Sometimes it's 90 days, but on average, about 30 days. And that would be the slide on the right-hand side that you'll see. That is when they lock in their interest rate when they go under contract. So these two slides trail by about 30 days. The slide on the right trails the slide on the left by about 30 days. So I expect we'll see lower rate locks when we look at this next month. The black line on the right-hand side will be down a little bit because there were fewer people applying 30 days ago during Memorial Day week.
So just more evidence is going to be soft for the rest of the year. So for those of you guys working with buyers, the sellers aren't getting a lot of traffic. So it's a good time for you to be able to hopefully get a little bit more attractive a deal than you would have gotten this time last year. If you're working with sellers, I think the message on this is that every showing counts. And even though it's really kind of a headache to prepare for a showing, you got to take them all seriously. So, Joe, it's interesting on this chart. It looks like the number of people who've got a really great deal under 3% on their mortgages is declining. Are those people just refinancing because they need to get cash out to pay off their credit cards, or what's happening with that?
I love this chart, Lon. When you sent this out a week ago or a month ago, I was like, this is exactly what we've always been saying. So on the dark blue in the bottom right-hand corner, you see that 40% of people in roughly 2020 had a mortgage interest rate below 3%. And a lot of those folks said, I've got an interest rate below 3. I'm never moving. I'm never refinancing. I'm never doing anything else. And what I said back then was, I think that's true for a period of time. I don't think it's true forever. And this chart shows that, because life goes on. People still get relocated for jobs. People still get divorced, get married, need a bigger home, need a smaller home. And you're seeing that lock-in effect, which is this dark blue section of people that say, hey, I'm never going to sell my home. That is going down because life goes on, right? People have to move for all the various reasons in life, and that is freeing up some inventory. I certainly don't see anyone refinancing their 3% interest rate. I've not done one of those yet, but we do see a number of people that are selling that have an interest rate of 2.5%. And for whatever life circumstance, they have to sell. And that dark blue, that rate below 3%, is being replaced with the lighter blue in the top right-hand corner of a rate greater than 6%. So we are seeing people trade because of life circumstances.
So the good news on this, if you can kind of extrapolate what this might look like 5 years from now, the people under 3% is going to be maybe a half or maybe a quarter of what it is right now. And the people who are at 6% and above is probably going to be, what do you think, 30 or 40% of the chart. And as we get closer and closer to having a majority of the loans in place in America be close to the historical rate for a mortgage, which is like 6 or 7%, the speed of the turnover in the market is going to increase a lot. So we just have to kind of get through this transition period, which is a little bit uncomfortable. But I don't know why I've suddenly got an echo. I'm not doing anything differently. I apologize.
I don't know what happened, but you sound okay. It goes in and out.
So one thing that's changed is that people are staying in their homes a lot longer than they used to. And I haven't seen any good conclusive evidence as to why that is, but it's definitely a factor.
Mm-hmm.
Wow, this echo is a headache. I am so sorry. I'm going to mute for a minute. Nick, do you want to talk
Yeah, I'll
about
talk
this
about
one?
this one.
Okay.
Yeah. So this is a great slide that talks about showings per active listing. And this is a really good leading indicator. As you have more showings per active listing, that shows that you're going to have more offers, more activity, and thus higher appreciation. So this dark red line in the top left, that was the peak of activity in 2022. And we have seen that slide down to this pink line, which is the activity in 2023. And that green line was the activity that we saw in showings per active listing for the average of 2017 to 2019. Now, this dark blue line at the bottom left, that's what's happening currently. So we are off at least 10, sometimes as much as 20 or 30% in showings per listings, which goes back to what Lon mentioned earlier. There's just a lot of buyers on the sidelines right now. So if you're working with buyers, there is less competition currently. And I personally think, and the data shows me, this could be a really, really great opportunity. And Robert asked, showings per listings, this is per month. This is per month. So if you look at May of 2024, and we're right around just over 6 showings per active listing per month.
Historically, pre-COVID, you'd expect to be closer to 10. Oh, the echo's gone. That's great news.
Whatever you did, Lon, you fixed it.
I don't know what it was, but anyway. So I want to show you this. I just got this chart. This is like so much fun. So this chart is a variation of what I showed earlier. It's a long time series. That's why the graph looks a little bit different. Of home prices, which is the blue line, and household income, which is the red line. And you can see that home prices have gone up faster than income, and that's leading to this affordability gap. Let's look at these other countries: Canada, the UK, Australia, and France. They all have the same problem, but worse than us. So we're not alone in this. I'll tell you what, I'm going to sign back in. Joe, do you want to talk about this slide here? And I'll be back in just a minute. Hopefully the echo goes away.
Yeah, absolutely. So one thing we're looking at here is what's happening next for rentals. And the distribution of rental housing units by size, what you see is roughly 33% of the market is single unit rentals. So this would be a condo, this would be a townhome, single family home. And that is a really big section of the market. And that is where our, what I would describe mom and pop investors, not in a rude way. I'm also a mom and pop investor just by myself buying properties. There's a lot of opportunity there. And then the 2 to 4 units, that's another big segment of the market. And 50 units and up, or the 25 to 49 units, those are, the 50 units and up is a really big segment, but that is something that's really going to be reserved for institutional investors that have hundreds of millions, maybe even billions of dollars, that have a big, 200 unit apartment complex. So when I look at this chart, what I see is the 1 unit and the 2 to 4 unit makes up 45% of the rental housing units. That's a lot of opportunity for buyers that are small investors that say, hey, maybe I want to look at buying a duplex. Maybe I want to look at buying a single family home or a condo. And then the other one that jumps out at me is the 5 to 24 units. This is usually too small for a giant investment fund to be interested in, and it's too big for most mom and pop investors. So this can be a really sweet spot if it's yourself, plus maybe a family member or a close friend, and you want to buy a 6-unit apartment complex or an 8-unit apartment complex. There can be some really good efficiencies in that price range and that unit count, because there's not as many people in the 1-unit properties that can trade up to those 6 or 8 or 10 units, and it's too small to get a lot of institutional attention. So I think that could be somewhere that you could really look. And Nick, I believe you've got, or you recently worked on a medium-sized unit like that. Is that right?
Yeah, I own a 25 unit apartment complex, and these percentages are certainly true to form. I can assure you that, in continuing to look for more uh, properties, that 5% is very true. It's very hard to find properties in that size range, but there is
Mhm.
much less buyer competition in that regard, such as is with the 5 to 24 units as well.
Yeah. Yep. I think that's exactly right. Now let's see. Is Lon back? Were you able to rejoin us, Lon?
Sounds like I have an echo too out of nowhere.
Yeah, I was going to say, I don't know if I can control the slides. Oh, I can. Great. So the next thing we want to look at here is vacancy rate. So vacancy is still really, really low, particularly in Colorado. The average vacancy, I don't know if we've got it on here. We don't have the average vacancy, but in, high demand rental markets, Colorado, Utah, Wisconsin, I think this is going to continue to show increased rental prices. Now, they're not going to go up as much as they did when vacancy was 1%, but we're still here well below 5%, which is going to lead to increased rental demand and increased rental prices over the short, medium, and long term. And this is where we've got change in rents. You saw that rents really, really increased a lot back through the COVID unicorn years. And then they began slowing down, but we really haven't seen any rent depreciation. So generally, rents don't go down a whole lot. They might stay flat, which is kind of what we're approaching here. We're right around 0% increase over the last 6 to 8 months. But I don't think that you're going to see rents suddenly start to really fall off a cliff. So I think that's an important point for our landlords on the call. Now, if you are in Colorado, there's been a lot of new regulation, lots of regulation that, and Leslie said, nobody wants to live in Mississippi. That is true. I think if we go back and look at that chart, there's a lot of vacancy in Mississippi. So do not buy investment properties in Mississippi. It might come with some challenges. Now, there's been a lot of new laws in Colorado that really favor the tenant. So we've had a lot of our clients that say, you know what, I'm selling all of my rentals in Colorado. It's just too much work. There's too much red tape. It's too difficult. And I think this presents opportunities for 2 segments of the market. Number one, first-time home buyers, right? A lot of mom and pop investors like myself own condos, townhomes, small single families. Those can be sold. And who's going to buy those? Obviously, a first-time home buyer. The other person that might buy those is another mom and pop investor that has a professional property manager. And so if you're worried about these laws, I would encourage you to reach out to Eric Ross over at EcoSpace Property Management. He knows these laws inside and out and will keep you out of trouble and keep those units filled and performing for you. So don't let these laws scare you. If you are a landlord and you're managing it yourself, that might be scary, but there's always the opportunity to hire a new property manager. And Leslie said, all this regulation in Colorado has me think of selling too. Never want to marry my tenants, but now you're locking them in. I think that's a great point. A lot of these things are all in favor of the tenant, and can make it nerve-wracking for landlords. And that's where I personally have always used a property manager. But I think having that professional to keep you out of trouble and make sure that all the rules and regulations are being followed is a really unique value right now in the current market.
To add to that as well,
yeah,
Joe, to Leslie's point on the commercial, I've been speaking with a lot of commercial brokers in Colorado, and they've been seeing a lot of legacy owners wanting to unload their properties for a lot of the reasons, such as this regulation. And every day I'm talking to new investors who want to invest with Ironton Capital, and they're also selling their properties for that reason and a few others as well. So, just with everyday conversations, we're seeing that quite a bit.
Yeah, I completely agree. And short-term rentals, not nearly as much enthusiasm as there was in the past 3 or 4 or 5 years. And what we're seeing, short-term rentals, when you buy a short-term rental, an Airbnb, the day you close on that property, you are no longer in the investment business. You are now in the hospitality business. And people are finding that it is much more difficult to run an Airbnb than they thought that it would be. It looks great on paper, looks great on the spreadsheet, but there's a lot of work and a lot of time and energy that goes into that. And let's see. This is also on Airbnbs. Supply is growing because we had a lot of people buying Airbnbs because it looked so great on the spreadsheet. And that has shown to be actually a pretty challenging thing to do, is successfully run an Airbnb. So that supply is growing, but I do think we're going to start seeing more of those people divesting of those properties as time goes on. And Leslie said, so true. Have never done so many sheets and towels trying to make the numbers work by doing the cleaning myself. That's a lot of work when suddenly you're in the housekeeping business, right, Leslie? All right. And as we're wrapping up the last couple here, we're seeing some would-be sellers that are thinking, hey, I want to sell, but I really like my 3% investment property or my 3% mortgage rate. I'm going to keep it as an Airbnb. And they're doing exactly what Leslie said. Hey, I'm just going to keep this. I'm going to keep my costs down by doing it myself. But they're going to find out that is a lot more work than they really want to do. And so some of this will be inventory that comes up in the next 6 months to a year as people see it is more difficult to have those short-term rentals than they really thought. And I think that is just about everything we had here. I guess builders building smaller homes. This is one thing that is keeping home builders going strong, is the average medium square foot of new builds has really, really come down. And we're seeing it roughly 2,067 square feet in the current market. So that is still giving some opportunities for first-time buyers to get into those entry-level homes. And again, we're seeing, that average square footage of 2,700 square feet back in January of 18 has come way, way down. And now we're at average square footage based on this survey is below or right at 2,400 in the most recent quarter. And Nick, if people want to learn more, if I've got some investment properties, I'm a landlord and I am worried about regulation and I want to sell 1 or 2 or maybe even 3 of those, are there some opportunities that I could reinvest that capital with you there at Ironton? How would that work?
Yeah, so I just put in my email address into the chat box. If you're somebody that is looking to potentially sell some of your rental properties, invest passively with Ironton Capital, or you want to utilize your self-directed IRA, such as through that second bullet point, how to manage your Roth IRA for big tax savings. If you fall into either of those categories, get in contact with us. We can sit down, run an analysis on one of your properties or your portfolio, and present a business case on what makes the most sense from a number standpoint. So feel free to get in touch with me, Nick at irontoncapital.com. We can set that up and we can start that conversation.
And we are going to have a presentation. I believe it is on July 16th. I feel like it's in about a month. And we're going to be talking about how to do an analysis on, does it make sense to sell your property and invest that money with Ironton? Does it make sense to keep the property and maybe do a home equity line of credit and invest some of that equity with Ironton? Or does it make sense to keep that property and do a cash out refinance into a new mortgage and invest those proceeds with Ironton? So make sure you guys keep an eye on your emails for that. I think that'll be really useful as we look at ways that you can deploy that equity into more favorable returns like what Nick and Lana are able to offer over at Ironton. And then I did see one question here. So Lana, this is a question for you. Could we create a Your Castle area map color-coded to show subdivisions that are subject to metropolitan fees, which of course come along with higher tax bills? I don't know how easy or difficult that would be to do.
For data scientists, if that's something we could do, that's a really fun question. I like that. And building
Yeah.
on what Joe was talking about just a second ago, we found a couple lenders that can do second mortgages on non-owner occupied investment properties, which is something new. We haven't seen that in the market for a
Mhm.
while, so I'm really excited to be able to share that with you guys in about a month.
Yeah, we rolled that out about 3 months ago, and that's a question that I've gotten for years and years and years. Joe, can I do a HELOC on my investment property? And for years, you could not do it. But again, about 3 months ago, we rolled that out, and some other of our partner lenders that we're going to talk to next month have that as well. So it could be a really good option for you if you've got some locked up equity in your rental properties.
Love to get some more questions from you guys.
Yeah. Any final questions? Type those into the chat. We're always happy to answer those. And Lon, you sound really good. You're logging off and logging back on.
Yeah, I think
came out
that
well.
solved it, wherever that echo was coming from. So I'm glad that solved it. Well, otherwise, guys, thank you so much. If you think of a question after we stop, which of course 5 of you will, just send me a text or an email and I'll try to answer it for you and be a good resource for you.
Yeah, thanks so much for joining us, guys. Really appreciate it.
We had
Lon,
a-
Nick, thanks for having me on. I always appreciate getting to chat with you guys about this topic.
We had a question
thanks.
sneak in. We had a quick question sneak in if you guys want to address it.
Yeah.
James is asking, what are the strongest investment markets in the United States?
We generally think the Southeast U.S.
Mm-hmm.
All right. Well, have a great evening, everybody.
Yep.
Thanks, guys.
See ya.